Imagine one of the world's largest economies, the very powerhouse of global manufacturing and trade, crumbling before our eyes. What happens when over 1 million restaurants close their doors, entire industries teeter on the brink of collapse, and consumer confidence evaporates overnight? This isn't some distant hypothetical, it's happening right now, and the world is watching closely. China, long celebrated for its rapid growth and economic dominance, is facing an unprecedented financial crisis. It's being called the worst economic collapse the country has seen in over 4 decades. But why? What's causing such a monumental downturn? The answer lies in a perfect storm of interwoven crises that are shaking the very foundation of China's economic strength. For starters, over 1 million restaurants across China have shuttered their doors as the economy falters. It's not just a symptom of the problem, it's a glaring indicator of how widespread the pain is. But it doesn't stop there. China's real estate sector, which once seemed like an unstoppable force of wealth creation, is now experiencing a collapse even worse than the 2008 global financial crisis. The very industry that once powered China's meteoric rise is now dragging it down. Then there's manufacturing, the engine that drives not only China but global supply chains. The problem? Massive overcapacity. Factories built to feed the world's insatiable demand are now struggling to stay afloat as bankruptcies rise. This creates a ripple effect, threatening not only China's economic future but the availability of goods and the stability of industries worldwide. At the heart of the issue is a deflationary spiral. China's 5th consecutive quarter of deflation. Prices are falling but so are wages. Consumers, already weary, are tightening their belts. Wage deflation means people have less to spend, leading to a dangerous cycle of reduced demand, further price drops, and even more job losses. This vicious cycle threatens to paralyze any chance of recovery. Worse still, consumer confidence in China is plummeting. It's reminiscent of the uncertainty and fear during the peak of the COVID-19 pandemic. People simply don't believe in a swift recovery anymore. This growing pessimism, combined with falling wages, is leading to a population that's spending less and saving more. A scenario that could lead to further economic stagnation. The global ramifications of this are already beginning to show. Foreign direct investment in China has hit record lows, and businesses around the world are starting to rethink their exposure to the Chinese market. The fear is real. What happens if this economic downturn continues unchecked? China's economic woes don't just stay within its borders. A crisis of this magnitude has global repercussions. For one, the collapse in demand could lead to lower commodity prices, impacting economies far beyond China's shores. The United States and other nations could feel the pressure as deflationary trends spread, introducing volatility into financial markets and disrupting international trade. As China faces its toughest economic challenge in decades, the world must brace for the potential fallout. Could this be the beginning of a new global financial crisis? Only time will tell, but one thing is certain: the world is watching China closely, and the next steps could reshape the global economy as we know it. Stay informed and prepare for the unpredictable ripple effects that may come.